Hi everyone, welcome to the video. Today we're going to be talking about the option Greek called delta. Let's get started. Hey, welcome back to all of our subscribers, and if this is your first time here, my name is Kirk with Tactical Options Trading, and we make videos just like you see here on a consistent basis where we talk about the stock market and options trading. If you haven't already, I hope you'll consider clicking this button right up here and subscribing to our channel. And if you'd like to get notified every time we post a new video, click that bell so that you don't miss out on any future content. All right, guys, let's get going. All right, today we're talking about the option Greek called delta. Now, when we talk about option Greeks, there are 5. There is gamma, theta, vega, rho, and delta. And I would say that delta is probably the most understood option Greek, but there are some nuances. And hopefully in this video, we can dial in a little bit deeper, dig into it a little bit deeper, and understand how delta affects option pricing. So let's get this party started. So what is delta? Well, delta measures the rate of change of the price of an option with respect to a move in the underlying asset. So more specifically, delta tells us how much the value of an option would change for every $1 increase in the movement of the underlying asset. So let's take a look at an example here of Caterpillar. Now, looking at the 123 call option on CAT, we can see that this has a delta of 54 cents. What this means is that for every increase in the value of the stock by $1, our option is going to increase in value by 54 cents. So this is nice to know, right? Because knowing what the delta is can help us to make a prediction of what the value of the option would be with a movement in the underlying stock. So let's go back to our example here of Caterpillar, and we can see how this works as we go further in the money by $1 increments, which would be representative of the stock increasing in value by $1. So again, we're looking at the 123 call option, and we can see that the market price there is $3.75, and the delta is 54 cents. So if we increased, if the stock increased by $1, which would represent being in the money one more dollar, and we went up to that 122 strike, you can see that the market price here is going to change from $3.75 to $4.30, which would be approximately 54 cents. So, we take the difference of the 122 call option market price versus the 123 call option market price, and you can see that the value has increased by approximately 54 cents. Now, let's say again we went in the money one more dollar, or the stock was to rise one more dollar in price. That would put our option one more dollar in the money, and you can see that as we go from the 122 strike into the 121 strike, you can see that again that option value or that market price has changed from $4.30 here to $4.90, and you get that by taking the $4.30, and of course we moved in the money by one more dollar. We'd take the $4.30 and add that 59 cents onto it, and that would give us a value of $4.90. So this is really nice to know, because if we wanted to see what the value of an option were, if the stock were to move, let's say like $3, and we bought the at the money call option at 123, well, all we would need to do is go in the money $3, and we could see that from $3.75, if we went $3 in the money, we would be trading here at about $4.90. So that helps us to give us an idea of option pricing as that stock price moves higher. So hopefully that's been helpful there. A lot of people ask all the time, like, well, why is the delta of a call option positive and the delta of a put option negative? Well, the delta of a call option is positive, and the reason being is that the increase in the stock price would make the call option worth more. So think about it in these terms. So if you bought a call option, you're expecting that stock to increase in value. So any movement of the stock price moving up or increasing in value is going to positively affect your call option. So a deep in the money call option will have a delta of 1 and will act just as if you were long the stock. So, as we get further and further in the money, at some point that delta is going to reach a delta of 1. And at that point, every dollar increase in value of the stock, your option is going to increase by $1 as well. So you're 1 for 1 on those deep in the money call options. Now let's take a look at the delta of a put option, and the delta of a put option is negative. So you have to kind of think about this here on the put option side. But you know, a delta of a put option is negative, as an increase in the stock price would make the put option worth less, or it's negatively going to affect your put option. So think about it in these terms. So if you bought a put, you're expecting that stock to go down. So if the stock were to increase in value, that's negatively affecting your put option, and that's why it's negative on that put side. And a deep in the money put option will have a delta of a -1 and will act just as if you were short the stock. So at some point, if that stock were to trade down and your put became in the money and it became deep in the money, and you're trading down there around that -1 delta, well, if the stock were to increase in value by $1, that's going to negatively affect your put option by $1 because it's moving 1 for 1 at that point. So that's why on that put option side, those deltas are negative, because a positive increase in price on the stock is going to negatively affect your put options. So you can see that here on that delta column, down in the deep in the money deltas, deep in the money put options, we have -1 on those deltas. So if we were to graph the delta of a call option, you know, let's put it on a graph so we can see what it looks like as the stock starts to move and, you know, we become in the money and out of the money. If we were to graph it, it would look something like this. So again, we're going to take the X and the Y axis here. Along the bottom here, you can see that we have the stock price, and that stock price, as the stock price starts to move higher, that's going to affect the delta, and it's going to increase that delta in effect up into a 1. So if we're looking at the stock price and the stock price is moving higher, at some point these out of the money call options are starting out as a 0, but as that stock starts to move higher and our call option becomes more and more closer to in the money, at some point it's going to be at the money. So the stock price and the strike price are going to be at the same point, and the at the money call options are going to have a delta of 0.5. Now as we continue to go higher on that stock price, and that stock price starts to increase, we're going to eventually reach a delta of 1, and that's where that stock price and the strike price, every movement in the stock price is going to have a $1 positive impact on our call option. Now let's take a look at the delta of a put option. Now the graph of a delta of a put option is a little bit different because we start out at a -1. So when we're talking about delta, again, remember it's based on a positive increase in the stock price. So what is a positive increase in the stock price going to do to affect our put options? So again, we're going to start out down here at a -1, and you can see that as we start to increase in our stock price, that is going to change our delta from a -1, and at some point we're going out of the money on the deep out of the money put options, and as the stock starts to rise in price, at some point we're going to be at the money, and that's going to be a -0.5 delta at the money. And then as soon as, you know, as we start to go through that at the money point, our delta is going to reach 0 as that stock continues to rise in price. Because remember, on a put option, a rise in the stock price is going to negatively affect our put options. Is anytime the stock moves up, what does that do to your option? Well, on call options, it's going to positively affect it. On put options, it's going to negatively affect it. So a decrease in time or volatility will also have an effect on delta, and you can see here that this red line here represents the option at expiration. The blue line would be like where we are right now today. So as we move forward in time, the delta curve will start to look more like the step function, and at option expiration it's going to be equal to it. So an in the money call option will approach a delta of 1 as it approaches expiration, since the extrinsic value is minimal and the option is in the money. So we're looking at a call option here. You can see that the in the money call options, here's the at the money price. Everything on this side would be in the money, and you can see that as we approach expiration, the delta is going to climb until it starts to reach that delta of 1. Now, if we're looking at the out of the money call options, that delta is going to approach 0 as we get closer and closer to expiration, because the intrinsic value is nil and the option is out of the money. So let's look at it on the options chain to kind of see what we're talking about here. So we're looking at the SPX, and you can see at the time of this video, we were looking at the 10 December series, and that had 0 days until expiration. So these options right here are expiring today. And then we have this series that's the 12th of December, which is 2 days out. So these are expiring in 2 days. So let's take a look at the $2,600 strike. And you can see on the $2,600 strike, the options that are 2 days from expiration have a delta of 73, or a 0.73 delta, where as we get closer and closer to that expiration or the day of expiration, that delta jumps up to a 1. Now we're still looking at the same strike price. We're just looking at it in 2 different series. So back to our graph, as we get closer and closer to expiration, the delta on those in the money call options is going to approach a 1 delta. So now let's take a look at the out of the money options and see how time affects those. So we're going to be looking at the put side in this scenario, but we're looking at the $2,600 strike. You can see down here, we have a delta of 0.28, and as we get closer and closer to expiration or on expiration day, we start moving towards a delta of 0 because they're out of the money. That intrinsic value is pretty much nothing there. There's nothing there on those out of the money options, and so that delta starts to approach 0 as we get closer and closer to expiration. And we can see that here looking at this this trade tab here. All right, so it could also be mentioned here that when buying options, generally options traders will gravitate to buying the options with a 70 delta. That tends to be the sweet spot, as you're not paying for the high price options that have a delta of 1, because when we're paying for those delta 1 options, they are definitely priced higher because they're in the money and they have a lot more intrinsic value. But buying those 70 deltas, you're buying an option with some intrinsic value, and you're getting the biggest bang for the buck when the stock price starts to move. So let's take a look at a 70 delta call option. And we hear about people buying the 70 delta call option, or we're selling the 15 delta put options, things like that. So when we're talking about options and buying options, it's not all the time we're talking about strikes. We want to look and see what that delta is too, and generally traders will gravitate towards this 70 delta. So this is what a 70 delta is right here. It's not going to be exactly a 70 delta. It's going to be somewhere around that 70 delta, and so that's what you'd be looking for on an options chain if you're looking for that 70 delta. Now, an options delta is also the estimated probability of the stock expiring in the money. So if you're looking at a delta 50, basically that's at the money, and that has a probability of expiring in the money of 50%. So that makes sense, right? If you're at the money of 50 delta, you have a 50-50 chance of that option expiring in the money or having some intrinsic value at expiration. Now, if you're looking at the delta 25, that has a 25% chance of expiring in the money, and so that would be an out of the money option. This 25 delta would be an out of the money option. Now, if you're looking at the 16 delta, which is a 1 standard deviation, say you're looking at that 16 delta, if you're selling options and you wanted that option to expire out of the money, you could sell that 16 delta option, which would be about a 1 standard deviation move on the stock. So let's take a look here at a probability of being in the money on the options chain. You can add this on Thinkorswim. You can add the probability of being in the money, and I wanted to add this column on here next to the delta column so that you can see that if you don't have this column, this probability of in the money column, you can use delta to help you know if that option, what the probabilities of that option of being in the money are at expiration. So you can see here we got the delta column and the probability of in the money column side by side. Now, if we just took a look here at the 137.5 strike price, you can see that the delta is a 0.78, but we have a probability of in the money of 76.7. And you can see all along here that the deltas and the probabilities of in the money are very close to each other. So if you don't have this column in your platform, you can use the delta column to help you know what options to buy or to sell based on this delta, and you could use that as the probabilities column as well. So if you wanted to know what the probability of that option was being in the money at expiration, you could use delta as well to do so. So let's look at some takeaways today from our video. Delta measures the rate of change of the price of an option with respect to the move of the underlying asset. So we know that delta is the rate of change of the price of the option with respect to the move of the underlying asset. So an option's delta is also the estimated probability of the stock expiring in the money. And then also the delta of a call option are positive and the deltas of the put options are negative. So guys, hopefully this video has been helpful. Appreciate you guys watching it. Thank you so much for watching. And if you guys have any comments, please post them in the comment section below. If you guys have ideas for videos too that you'd like for us to make, please post them in the comment section below too. We'd love to make you guys a video. Thank you guys so much for watching. If this video has been helpful or beneficial, we'd appreciate it if you give it a like and subscribe. Share this video if you think somebody else could benefit from it. My name is Kirk with Tactical Options Trading. Guys, thanks so much. Catch you on the next one. Bye-bye.